better than what the market is expecting, we should be expecting reasonable returns in line with earnings growth. So from that perspective, yes, we do believe that risk-reward ratio is probably better for large caps as compared to mid and small caps at this point in time.
And is that the reason why you are marginally underweight the other two asset classes, mid cap and small cap?
That's right. As far as large caps are concerned, they are trading close to their historical averages. Whereas if you look at mid caps or small cap basket, they have been trading at a premium to their own long-term averages, as well as premium to large cap valuations at this point of time. Hence, within equities, we would prefer a slight tilt towards large caps rather than mid and small caps at this point of time.
Then how do you bring in the extra return that or alpha to your fund, Harsha? Because we've seen in the last 6 months the mid cap and the small cap rally happening. You've been underweight mid cap and small cap. And we haven't seen much of movement in the large caps except for some of the few selected ones. How do you bring in that extra return to the portfolio for the investors?
See, it's not that in mid and small cap funds we are pushing large caps in the portfolio. In case of strategies or the mandates where there needs to be a mid cap concentration or a higher proportion, we are definitely putting that into the portfolios. But I'm saying wherever there is a allowance for going up or down in terms of allocation, we would rather have slightly higher allocation to large caps at this point of time. For the same reason that you mentioned, that the recent performance has been very, very strong. And even if you look at last 3 years, mid and small caps have significantly outperformed large caps. And that cannot continue in our view, given the valuation premium that we have already seen for mid and small caps. So at this point of time, we may have to bear some bit of underperformance in the short term. But from a risk tolerance perspective, it is out of our tolerance at this point of time to go higher on mid and small caps, even if the mandate allows you to take higher large caps. So from that view, we have increased our large cap bets in the portfolios where we could take a slightly higher proportion of large caps.
So, from an earnings point of view, are you seeing enough of headroom for the large cap companies to run ahead, given the kind of earnings we've seen for the first half of the year and what is being projected for the second half and FY25? You see enough headroom for them?
Definitely. The first half of earnings were much better than expectations, and we expect for the financial year 24 and 25 put together a CAGR growth of about 17% for Nifty basket in terms of earnings growth, which is a very, very decent growth. And at current valuations, which are trading around historical averages, we should be expecting something similar to the earnings growth if your exit valuations also remain at around the historical averages.
My question is, when you go about selecting a stock, the large caps are pretty much, well researched, and and it's very evident how they are going to give their earnings growth going forward. In your small cap and a mid cap portfolio, how do you go about researching the stock or selecting the stock so that they are at a minimum risk to the portfolio?
See, one, we rely on our in-house research. So our research team currently covers about 420 stocks in all, including large, mid, and small caps. So that's where we have our comfort on in terms of having a view on each of those businesses, valuations, etc. That's the starting point. We do not buy any stock that is outside this investment universe. And after that, we keep a diversified portfolio for mid and small caps so that the risk is also mitigated. We are not just looking at the possibility of higher returns, but also we need to plan for a bad day. So to that extent, we keep a diversified tilt to the portfolio. And keep monitoring the portfolios on a regular basis whenever there is a company-related development or an earnings development or some industry-specific news. Or if the valuations on a relative basis move up, then also probably we would have to rejig the portfolio. So these are some of the things that we keep doing.
Given the kind of run-up we have seen in the small cap and the mid cap space, have you been churning your portfolio in that sense?
Usually, we do not use cash as a tool to manage performance or risk. Generally, we remain fully invested across our portfolios. But yes, compared to large cap funds or large cap tilted funds, we do have slightly higher cash in our portfolios when it comes to mid and small cap funds. For most of the other funds, we have about, let's say, 1 to 3% cash at this point of time. Probably in case of mid cap and small cap funds, we have about 5% cash. But this is not something that we have actively managed, as in we have not sold stock to create that cash. The inflows have been coming in, and we have been little gradual given the discomfort of the valuations to deploy that in the market. However, beyond a certain level, we do not keep cash in the portfolio. If it increases beyond our internal limits, then we would probably go into some of the defensive names or relatively better names in terms of valuations.
What we saw was before the election results were supposed to come out, a lot of funds went into cash, and they were not able to deploy that immediately as soon as the results came in. Were you able to deploy that cash and get the returns that came as part of the run-up post election results?
Sajeet, that's exactly the reason why we do not keep cash beyond a certain level in any of our funds, because cash is always a double-edged sword. You will gain if market falls, but you will lose out in case of a sharp rally in the market. And some of these events are difficult to predict, especially in the very short term. So that's why, as a policy, we do not use cash as a tool to manage our performance. Hence, we were almost fully invested in our portfolios, as I mentioned, even before the elections. And in the recent rally that we have seen, we have really not felt that heat by keeping cash and losing out on performance.
Harsha, before we go into sector-specific, themes, my final question to you is that, as a fund manager who manages over 1 lakh crore in asset under management, how easy it is to do the allocation across various asset class and take these bets. So while the street has gone overboard on mid cap and small cap, you've been marginally underweight. When they are slightly underweight on the large caps, you've been overweight. So it almost seems like a contrarian view that you've been playing here.
Sajeet, let me explain that once again. It's not that in all our funds we are underweight on mid and small caps, right? The mid and small cap funds have to have a minimum of 65% in that as per the regulations. In those funds, we are not underweight on mid and small caps, right? But there are also funds like multi-cap funds or flexi-cap funds where you can have a tilt towards any one of these baskets based on the regulatory environment. So in those schemes where we have a leeway to overweight any of the segments, large, mid or small, we have chosen to overweight large caps simply because of the risk-reward condition that we are seeing going ahead. It's not about a very short term in terms of how each of these baskets have done, and you should not just chase the momentum. But when you look at valuations and the relative growth that you can expect from these segments, it's quite clear that large caps are better suited at this point of time for a diversified portfolio which can overweight that segment as earnings are still expected to be decent in high teens, whereas valuations are not as expensive as mid and small cap. So that's the only reason for us to have a slight tilt towards large cap. It's not that we are avoiding mid and small caps. Let me repeat that.
Harsha, stay tuned. After the break, we'll discuss some of the themes which we've been investing on. Banking, IT, cement, industrial products, some of the heavyweights or large weights that you have put in your portfolio. You're watching the Portfolio Manager, and we'll be back after a short break. warm welcome. You're watching the Portfolio Manager on NDTV Profit, and with me is Harsha Upadhyaya. Harsha manages a total asset under management of over 1 lakh crores for Kotak Mahindra Mutual Fund. Harsha, thank you for joining us on the Portfolio Manager. I've been looking at some of your key funds, the bigger ones being the Kotak Flexi Fund, where you have banking exposure of nearly over 23%. What is your view or house view on the banking space, and within the banking space, have you been able to segregate yourself between the PSUs, the private sector, and the NBFCs?
If you look at the large cap valuations, as we discussed before the break, they are quite comfortable at this point of time. And if you were to pick one sector amongst large cap names, which is quite reasonable in terms of valuations, that would be banking, I would say. And within banking also, especially the large names, whether it's private sector or the public sector, have not done as much as some of the smaller names in the sector. And we continue to believe that this is one basket where earnings growth is going to remain quite healthy in the medium term. There are no asset quality issues. And because of the recent underperformance over the last couple of quarters and the fact that most funds could be also underweight on this segment, we believe that this gives us comfort in terms of not only downside protection to a certain extent, but also in terms of getting outperformance going forward. So we have been very positive on this segment.
But have you been more positive on the small and mid cap space within the banking space, which has seen a good run up in terms of some of the players have seen good run up in stock prices, or the bigger ones, the big boys of the space, the ICICIs, the HDFCs, and the SBIs of the world?
Again, we do not chase momentum at any point of time. We go by fundamentals and we prepare our portfolios from a medium to long term perspective. So at this point of time, we believe that the large cap names will give you better returns from a medium term perspective on a risk adjusted basis. So most of our holdings are tilted towards large caps in the banking.
Another sector which is very interesting is the IT sector. You have nearly over 7% in the flexi fund exposure to IT sector, and we've recently seen IT also running up. What is your house view on the IT sector? Because we've seen subdued performance coming in from the IT. Many of the analysts have already written off FY24 as for IT companies. Do you see FY25 to be a revival year, and that's what is driving them as well?
When you look at the global growth continues to be sluggish. There is no reason to cheer for looking at higher growth in terms of global growth. As far as IT segment is concerned, I think it's more of a pet pivot, which has kind of helped the sector to kind of get re-rated at this point of time. So we have to go and watch whether the number of cuts that Fed has mentioned, which are 3 cuts in 2024, those come through. If you believe that these cuts are going to come through, then definitely even before the business momentum revives, probably you will see IT segment outperforming. We have already seen a little bit of that in the very short term, but our guess is it could have a little more legs at this point of time.
What about the industrial segment? That's also you're very bullish on that as well. How do you see the industrial products segment, moving going forward?
Clearly, even industrials have a very strong medium to long-term growth ahead of them. Most of the sub-segments have seen very good order flows and very good delivery execution as well. So this is one basket where if you look at earnings trajectory for the next couple of years, definitely that's going to be better than the overall market average. So to that extent, maybe some of the pockets may look a little expensive at this point of time, but as long as the earnings comfort is there, I think one should be remaining invested in these segments. So we continue to have positive opinion on industrials as a whole.
What I see in your portfolio is that the large FMCG companies, you're very underweight in them, especially the HULs of the world. What makes you so, uncomfortable with them in that sense? Because at one point in time, the consumption was a story. We've seen some kind of slowdown happening, but again, there's some, green shoot seen with respect to rural recovery and, consumption coming back. How do you see the FMCG space here?
We continue to remain underweight on FMCG. Clearly, this year's monsoon was deficient, so to that extent, it's going to have an impact on the rural consumption trends. Yes, to an extent, a pre-election boost to rural incomes or focus from the government in terms of a rural segment would help a bit of a revival in the consumption trends. But given that this year we had deficient monsoon, maybe all of that will not be visible very soon. So to that extent, given the relative growth that is much higher in case of industrials or construction as compared to consumption theme, we continue to bet more on construction and industrials and that pocket of the cyclical domestic story rather than consumption at this point of time. However, this could also be a dark horse kind of a segment if you believe that over a period of time the rural consumption trends will improve. We'll keep watching the trends and probably at some point of time we'll review our position. But at this point of time, we believe there is more money to be made on the cyclical side rather than consumption side.
On the realty segment, Harsha, are you more bullish on real estate companies or allied industries which are linked to real estate?
All of that, I would say. As long as real estate demand continues to be strong, the cycle continues to be strong. There are about 200 to 250 odd subsegments which will get benefited by the uptick in real estate segment, be it cement, some of the home building materials or paints or many of those ancillary industries. So depending on the valuation comfort and depending on the relative growth between the sectors, we continue to have many of those names in our portfolio. As a theme, real estate and home building is something that we are positive on. And we'll be selecting a few names in this particular theme in most of our portfolios. We continue to do them as well.
Harsha, you manage nearly $12 billion in asset under management. Do you also look at energy and new energy as a space there and ESG as overall theme in while you invest in these companies?
We do have a ESG fund which is mandated to look at ESG exclusion strategy, and that fund predominantly takes decisions based on what is the ESG exclusion strategy that we have. For example, we do not invest in certain sectors of the economy because of the ESG concerns in that particular fund. And similarly, for most of other funds as well, we do keep ESG in mind. It's not that we will be just buying or selling stocks based on ESG rating, but definitely we have to marry that with the fundamentals on the valuations and then take a call. So it's a complete analysis, including the financials as well as ESG in that sense.
Looking at the performance, Harsha, top three funds of yours is Kotak Multi-Cap, Kotak Emerging Equity, and Kotak Manufacture in India, while the bottom three is Kotak ESG Opportunities, Kotak Blue Chip, and Kotak Balance Advantage. Where is it underperformance coming for these three funds which are at the bottom?
See, for example, first of all, these are not apples to apples comparison because there is also a dynamic asset allocation product which is Kotak Balance Advantage Fund. It does not invest 100% in equities. It keeps varying its equity allocation based on the valuations and the market trend. So currently we are at about 50 odd percent, which is also in line with our view on the markets where we are saying that the market valuations are in a neutral zone as when you compare it to the historical averages. As far as ESG Opportunities Fund is concerned, the fund is benchmarked against ESG index, which is heavy on banking and IT, simply because these are the names which get higher ESG rating and they have higher proportion in the overall index composition. So to that extent, since these two segments have done inferior to, let's say, many of the other manufacturing segments, naturally, when you compare it to the diversified funds, it will look lower in terms of the last few quarters of performance. But as I said, this is not something that we should be comparing against, because these are all different themes and they are intended to do different things in the market. And that's how it should be seen as.
And the blue chip fund also in that way, because you are invested mostly.
Blue chip fund is investing more than 80% in large caps, and as you mentioned during the show as well, large caps have done inferior to mid and small caps in terms of performance over the last 12 months. And when you compare blue chip performance as against any other fund which has a higher proportion of mid and small caps, it will look like inferior performance. But this is a category where by mandate you have to be at least 80% invested in large caps. So those investors who have chosen a large cap fund, they would compare the blue chip performance in the category rather than comparing it across various other themes or various other funds.
So Harsha, because you manage a large amount of money, do you also look at event-based risk that can impact your funds? We have elections coming in next year, early next year. Do you, churn your portfolio or manage your portfolio in a sense that they are neutral to the event risk?
See, first of all, we do not take tactical bets or event-based bets in our portfolios. We are completely fundamental driven. We evaluate businesses, we evaluate valuation, and then construct a portfolio. Yes, to mitigate risk, not just the election risk, but any of the event risks, we keep a diversified portfolio as a measure to contain that risk. And we keep reviewing valuations and the opportunities that we have elsewhere in the market in terms of rejigging the portfolios. Specific to election risk, I would say that if you are entering the election phase at a very high valuations, then obviously there is a risk of either a disappointment or some profit booking, even when the outcome is more or less in line with expectations. But if you are entering elections or any other event at a valuation which is comfortable, then probably the downside risk is limited. That's how I would put it. Rather than changing our portfolios because of any event, we would continue to consider valuations at all point of time and then try to review our portfolios.
Harsha, it was a pleasure talking to you today at in the Portfolio Manager. Thank you for joining us on NDTV Profit. It was a pleasure talking to you today.
Thank you, sir.